I want to turn to Alan Lancz because I'll tell you, from my position, what I do for a living, what I've been doing, one of the things that really worries me about yesterday is that
4, 5.
Here we have an event that can really hurt retail investor confidence.
Exactly.
What do you tell clients? What do you tell people who say, my God, I don't want to be involved in that?
I agree. I think this is the third time in the last 10, 11 years that investors have been whipsawed with the market. And yesterday, there's no explanation. I mean, it's very difficult. If we have buy limit orders in and thought we got filled, under $40 in Procter & Gamble, and now that trade is not gone off. And, we were talking earlier that people with stop-loss orders.
Forgive me, I've been told to interrupt you in my ear. I'm really sorry to be so rude. Scott Wapner has breaking news. Scott.
Get back to Alan.
Here at the NASDAQ, where we're just finding out that Nokia is suing Apple in the state of Wisconsin for patent infringement. I'm told those patents in question relate to enhanced speech and data transmission. It's having a dramatic impact, at least on the surface. It seems as though it is on shares of Apple, which are down about 5 1/3%. They've been down throughout the morning, but certainly once that news hit the tape this morning, you did see an acceleration to the downside in shares of Apple. For that matter, across all of technology this morning, the NASDAQ is really getting hammered. Talk about almost a 3% decline. That is much steeper than we saw just off the open. In fact, it's been picking up in the last 10 minutes or so. Most big cap technology stocks, the likes of Apple, Google, Microsoft, Yahoo, Cisco, Intel, and Dell, for example, are all under some pressure. It's the chip stocks that are especially weak today as well. Intel's down 3 3/4%. Mark, I'll send it back to you, but the NASDAQ is on the cusp of a 3% decline here in the early going.
The Dow is down 1.8%, and the S&P is also getting hurt. I want you to be able to finish your thought. We were talking about investor confidence. Should investors feel confident now?
Well, I think this is a big blow, to investor confidence. On stop-loss orders, if an investor was trying to do the right thing and protect gains with the market up so much,
stopped out.
They got stopped out, and really, if there's an aberration and those trades shouldn't have been done, just like we should have owned Procter & Gamble, under 40.
Yeah.
Why are they stopped out? Why are they out of the market? And then the stock went back up. That's really got to rattle investors' confidence. I mean, I don't feel good about it as a professional, and I'm sure the retail investor, doesn't have a clue on what's going on.
I'll give you another one. Someone gets lucky, pushes the button, buys P&G at 40. Next thing you know, it's 50. He sells it. Then it turns out they void the buy. Now he's short the P&G.
Exactly.
Yeah.
It's a mess.
All right. I'm told now that our other guest is good, Paul Miller. Can you hear me, Paul?
I can hear you
And
fine.
we can hear you, which is even more important.
Yes, it is.
First of all, what is there a message? Is there a lesson? Is there something that retail investors should take away from yesterday?
Just volatility, I guess. I'm not really an expert on what the retail investors are going to do out there, so I'm not really qualified to answer that question.
All right, because we are now down 225 points on the Dow. We're still heading
Can I just highlight what's going on here? It's the technology that is absolutely plunging. Hewlett-Packard down 5, Microsoft down 5, Intel down 4.4, GE, Caterpillar, American Express. It's not the financials that are getting hit. It's primarily technology, and in the industrials and the cyclicals are also falling. Paul, I want to just take this opportunity, because the European markets are falling and because the banks are falling in Europe, and this may be disconnected to the technology moves that we have now or not. Can you talk to me about what you're hearing about the problems with liquidity and confidence in counterparties in Europe? This kind of general loss of confidence you have between financial market players, a liquidity issue similar, but in no means of the same magnitude as we had just before or just after Lehman.
That's exactly right. I mean, a year ago or after Lehman, banks wouldn't lend to each other because nobody knew of each other's exposures relative to these CDOs or the counterparty exposures. So you're getting a little bit of that again relative to all this sovereign debt exposure, and especially it's hitting Europe much more extensive than it's hitting the United States. But what it is banks don't trust each other anymore, and as they stop trusting each other, and when the rates to lend to each other go up, and that's what you're starting to see, and the credit markets start to freeze up.
So what does that mean as a form of transmission to the American banks, if anything at all? I mean, just talk to me about the links that might affect an American investor.
Well, you know, it's indirect with American banks. American banks don't have a lot of exposure to this sovereign debt, but they do have exposure to these sovereign banks out there, but not that extensively. But it's the second derivative that's really the big problem here, the overall influence of the credit markets freezing up that will start to creep into the United States.
But what are we to do? Alan, what are we to do?
Well, how it's going to affect the American investor, to answer that question, the majority of the earnings growth is based on the financial sector. And if financial regulatory reform changes the playing field, then they're going to strike at the heart of the most lucrative segments. And these analysts are going to have to change their earnings model. All of a sudden, the U.S. stock market doesn't look as cheap as what we thought. And that's why...
Very quickly, because we're out of time.
Sure.
Buying opportunity or hold off?
I think you buy on weakness, but very selectively.
Okay. Thank you, Alan Lancz.